Good evening and welcome to today's RTMA, June 14th, 2021, Technical and Fundamental Analysis. The disclaimer: suggested entry and exit points only suggestions, and these are time sensitive and for educational purposes only. We begin with the fundamental analysis. US Consumer Price Index, or the CPI, for all urban consumers increased by 0.6% in May on a seasonally adjusted basis after rising 0.8% in April. Over the past 12 months, the all times index increased 5% before seasonal adjustment. This was the largest 12-month increase since 5.4% increase for the period ending August 2008. So as you see from the chart, it's been steadily increasing since July of 2020 to the point where we are now at 268.55. That records a 5% increase. What does that mean? Well, let's look at the CPI really reflects the inflation rate. So let's look at the annual inflation rate in the US, which accelerated to 5% in May from 4.2% in April. It is the highest reading since August of 2008 and low base effects from last year, where the coronavirus pandemic hit the economy hard, rising consumer demand as the economy reopens, soaring commodity prices, supply constraints, and higher wages as companies grapple with a labor shortage. Biggest price increases were recorded for gasoline, which is 56.2%, used cars and trucks, 29.7%, utility gas services, 13.5%, transportation services, 12.2%, and apparel, 5.6%. Shelter costs were up 2.2%, and food went up by 2.2%. So here you see very clearly the consumer price index that we talked about in the earlier slide is now showing us clearly inflation is now at 5%, which is very high compared to the historical track record, as you can see, going back to July, from 1%, July 2020, from 1% to increasing steadily to 4.2% in April of 2021, and now 5% in May of 2021. So inflation is there. What does that mean to you and to me? The cost of goods are increasing, and therefore you will find price restraints or competitive restraints with the products from overseas. All right, inflation from a month-to-month basis, when we look at from a month-to-month basis, you can see it increased 0.6% in May and rising up after rising to 0.8%. So there's a slight decrease on a month-to-month May. From a month-to-month basis, the index for used cars and trucks continued to rise sharply, increasing to 7.3%, accounting for about a third of the seasonally adjusted items increase. Food shelter was 0.4%. The energy index was unchanged in May, with a decline in gasoline index again offsetting increases in electricity and natural gas indexes. This is all what's reported in the US. So from a month-to-month basis, although there was a steady increase from sometime in October 2020, it has now slightly moved below to 0.6%, largely offset by electricity, gasoline index offset by electricity and natural gas. So what does that all mean? It means the impact on interest rates. Inflation has a tendency to impact interest rates. US Fed funds rate, that is really the interest rate. This is where the Federal Reserve is the central bank of the US, and the Bank of Canada is the central bank for Canada. So policymakers generally reintroduce the economic recovery is far from complete, and that the inflation will move above 2% due to very low readings from early in the pandemic and transitory effects. After the transitory effects fade, inflation is expected to ease. The Fed left the target rate range for its Fed funds rates unchanged at 0.025% and said it will continue to purchase bonds at a rate of 120 billion on a month, despite acknowledging a rise in inflation and the improvement in economy. So the Fed is basically saying that this quick jump in inflation rate is really not something to be concerned about in the longer term. They see that this will adjust by itself. Well, that's hard to say, but we'll take a look at what's going on. So let's look at from an educational planet, educate some of us who have forgotten what we studied in the modules. So we want to talk about impact of inflation on interest rates. So on the left-hand side, in general, as interest rates are reduced, more and more people can borrow money. Okay, when you're low interest rates, more and more people can borrow money. The result is that consumers have more money to spend. This causes the economy to grow and inflation to increase. Okay, because there's more money chasing fewer goods until the supply chain gets caught. And on this chart here, you see the core CPI, the darker blue line, is steady between 1.0 to just above 2.0. The Fed fund rates have been going up from almost above 6% in 1998, and then dropping all the way down to 1% in 2002, 2003, moving back to above 5%, and so on. Right now, it's sitting at around 1%, just above. The opposite holds true. If you look at the right-hand side of the chart, the opposite holds true for rising interest rates. As interest rates are increased, consumers tend to save because of returns from savings are higher. With less disposable income being spent, the economy slows and inflation decreases. This is how central banks monitor or have policy to try to control inflation or keep inflation at close to 2% or 3% or whatever they decide, and they use interest rates as a method of controlling the economy. Let's look at coming back to Canada. Why do we talk about the US? The US is such a big economy that it has a direct impact on Canada. So we need to look at the US side of things to make sure that we understand what would impact Canada. So let's look at the Canadian inflation rate. Here, the annual inflation rate in Canada surged to 3.4% from 2.2% in March, higher than the forecast of 3.2%. It is the strongest reading since May of 2011. Prices rose in every major component on a year-over-year basis. Transportation prices were up 9.4%, mainly due to the 62.5% surge in gasoline prices, and shelter costs continue to increase to 3.2%. Homeowners' replacement cost index continued to trend upwards, increasing 9.1%, the most since April 1989, as higher building costs and determined for single-family homes contribute to a surge in the cost of newly built homes. Other upward pressure came from clothing and footwear, 1.8%, while food slowed down to 0.9%. On a monthly basis, consumer prices were up 0.5%, same as March. Now, what you need to point out here is that inflation is now at 3.4%, which explains or it should explain to you why there are lots of prices when you go to the supermarket or you go to buy some stuff. It's all higher prices, and that's directly due to inflation that has come into the system. Now, what does that do to interest rates? Bank of Canada left its overnight rate unchanged at 0.25% on June the 9th, as expected. The quantitative easing program was also kept at a target price of $3 billion per week, following $1 billion reduction in the previous meeting. The central bank judges that there remains considerable excess capacity in the Canadian economy, and that the recovery continues to require extraordinary monetary policy support. The bank remains committed to holding policy interest rate at the effective lower bound until economic slack is absorbed so that the 2% inflation target is sustainably achieved. In the bank's April projection, this happens sometime in the second half of 2022. Right, as we have been telling you before, and if you had an opportunity to listen to the last week's RTMA, where we really looked at the forecast of Bank of Canada and the Federal Reserve, and they all are saying that the real challenge will come sometime in 2022. Bank of Canada is saying in the second half. Our internal research shows that probably inflation will be a problem second quarter 2022 as the economy grows and expands, assuming nothing else happens, right? So one of the main concerns is to ensure that inflation, at least our track of inflation, we have to keep an eye on how it impacts certain industries. Definitely consumers will start tightening their belts if unemployment continues to be a problem. All right, then we look at unemployment rate. We talked about it. It's come down to 8.2% from going back to around June, July, 12.3%, now 8.2%. Unemployment rate in Canada increased to 8.2% in May from 8.1% in April, in line with the expectation. Employment fell by 68,000, with almost all of the decline in part-time work. Long-term unemployment, the number of people unemployed for 27 weeks or more, that's defined as long-term, held steady at 478,000. The labor force participation rate decreased to 64.6% from 64.9%. Meanwhile, the youth unemployment rate fell to 15.9% from 16%. Now, here is an important thing that we have to keep in mind. What is the unemployment rate? If there are more and more people unemployed, and there is a challenge for the economy, of course. For these people are paid through EI and other benefits, so you have to recognize that as the Bank of Canada decides that you have to have monetary policy, they have to have this stimulus packages. All this will eventually come in effective your pocket, because you will be paying for all these packages or all these stimulus programs that they decide to pursue. Now, the main concern, at least from the short term in the next 6 to 12 months, the short term challenge will be COVID-19 deaths. And you can see from this chart here, the United Kingdom, beginning around March, started turning down. Spain started turning down. Italy is turning down. UK is turning down. United States is turning down. But Canada hasn't seen the turn yet. And you see, even as late as April 23rd, it's still trending up. South Korea is flattening out. And this is one of the main challenges. Will the COVID expansion of at least the disease, the deaths per million starts increasing? Will they shut down the economies? Okay, that's a very important indicator for how the economy does in the next little while. Now, here's a little thing, and you can go look this up. You can Google COVID-19 recovery and reopening tracker. This was on June the 7th of 2021. As the governments and businesses turn their minds to the recovery and reopening of the economy, our team is closely monitoring updates for governments around Canada. The following summarizes the recovery opening measures which have been announced to date. And then you have in June the 7th, 2021, the government of Canada announced it will invest $12 million in Northern Ontario municipalities through the COVID resilience infrastructure stream of investing in Canada. The government of Ontario is contributing $3 million. The funding will support the rehabilitation of water and wastewater infrastructure repairs, municipal works, and so on and so on. So these are projects that they're creating, almost 15 million in northern Ontario. May 31st, the government of Canada announced it will increase projects, including the Enabling Accessibility Fund to improve access to services for persons with disabilities in Windsor, and and so on and so on, and it goes on. So all of these are make work projects that they are introducing so that the economy will be revived. So you want to just keep an eye on that. Although we'll let you know. This is a dated chart. We have not been able to get at this time data from Asia, so ignore this one. So the TSX on 10-day, 30-minute chart, you see the 52-week high, a new 52-week high was recorded on June the 11th, which is the Friday. It's recorded 20,155.92. Now it has clearly exceeded, gone beyond the 20,000 target, and is sustained slightly above the 20. It closed at 2138. There's a 500 point approximate increase in the last 10 days. The TSX ended higher on Friday, extending gains from the previous session as optimism about global economic recovery and higher energy prices underpinned sentiment. Data from Stats Canada showed Canadian industries operated at 81.7% of their production capacity in the first quarter. And you can see from the charts, somewhat RSI and stochastics show it's overbought, and the MACD histogram bars are flat. So there's a cross obviously here, and if you look clearly, it's turned red here, showing negative, and this is coming down from a high above the 70 mark, and this is gone. The RSI is also at overbought levels. So we expect the market to come down a little this week, but however, warning that what's happening in Asia and Europe will determine the movement for the TSX. From a sector perspective, and you can see all the sectors given here, outside the blue one, which is the health, really cannabis most likely anyway, so the rest of it is in an upward trend. So all the sectors are showing positive upward movement, which is very good for the TSX, because it's not just being dragged by energy or gold or something like that. So it's a general move for upward movement. It's positive news as investors. Gold and Bitcoin, the 3-month daily, and you see gold at 1,877. Bitcoin is below 36,000, 35,779 on Friday. Gold drifted lower slightly, pushing the future contract to the lowest close in more than a week as the dollar gains strength and against major currencies. Whenever the US dollar goes up, gold goes down. Analysts are of view that the rising price pressures will be transitory, and the Fed will not withdraw monetary support anytime soon. So the market has taken the assumption, and Fed has already said that they will continue to keep interest rates low and not withdraw their constant stimulus packages, both in Canada and the US. Now the banks and the on a 3-month daily, and you look at the banks, everything is uptrend, generally uptrending with somewhat flattening after having reached pretty high levels, at least from a historical perspective. So we are seeing the banks continue to be one of those that are being invested by both retail and institutional investors. Now the Royal Bank itself, they recorded a high in May of the 28th, 2021 at 126.90. It closed at 126.10, pretty close to the 52-week high, and you can see that the range is between 124 and 126, closing out to close to 127. I would rather wait for a pullback, as both the RSI stochastic show they are overbought. The MACD is diverging but histogram bars are flattening, although positive. So I would rather wait for a pullback to see how, if there's a pullback, then look at the possible entry into Royal Bank. TD, pretty much same. We have to wait for a pullback. Again, 89.12 was on May 27th. It's a little lower than the 52-week high. It's at 87.26 was the close, the $2 range. And the RSI and stochastics are both flat. In fact, all indicators are flat. So I will wait for a little pullback, maybe closer to 86.50 if I was going to go and look at TD Bank. Now, looking at crude oil, you see that crude oil is 70.91. Crude oil prices moved higher on Friday amid rising expectations that the global energy demand will pick up thanks to the acceleration in vaccination rollouts and the gradual reopening of businesses in several countries. The IEA expects energy demand to recover to pre-pandemic levels by the end of next year. OPEC said its monthly oil market report on Thursday that it expects global oil demand to rise by 6 million barrels per day this year from the lows of 2020, led by strong consumption in China, United States, especially the second half of this year, 2021. Now, why is that? Why there's optimism? Because in the US, it's opening its economy. I mean, if you have been watching any of the hockey games or the basketball games or baseball, you see that stadiums are full, it's crowded, they're not social distancing, there are no masks, and it's all opening, and more and more people are getting vaccinated. And so there's optimism, especially in the summer, and oil prices will impact travel. For sure, a lot of people will be driving and traveling and moving and RVing, things like that, and that's a standard thing in the United States as well as in Canada. So we have to look at the possibility of oil prices remaining above $70 in the coming summer, assuming again that all things remain the same. Okay, and OPEC sees China continuing to be growing, and we'll see how that pans out. Okay, all right. Now looking at WTI and the oil stocks, and you see IMO starting moving, it gained 28%, 29%, and whereas Suncor and Enbridge tracked the oil price, which was up 8.9%. We looked at IMO, it's a record set on June the 10th at 42.36. Now, while it's coming down, while the RSI and stochastic shows oversold, and the MACD cross possibility is there, flattening negative, the oil sand companies that the Canadian pension funds were most invested in during the first quarter were CNQ, Suncor, Cenovus, and Imperial Oil. That's where the force of the price of IMO, which was in the doldrums, both two factors that affected IMO. One was the Exxon's standard and climate change, and number two, the Canadian pension funds that were pouring money into the Canadian oil sands companies, and IMO benefited from it. So it's sitting at 41.24. It's still close to 42.36 52-week high, so I will just track it. I'll keep an eye on it as to see how it performs. Now, in the June monthly newsletter, which is what? Today's the 14th. About a week and 2 weeks ago, we gave you a list of stocks to track. Okay, on June the 4th, in the stocks that were given as Saputo, Toromont, West Fraser Timber, Bank of Montreal, Canadian Tire, and Bank of Nova Scotia. Right? They had all come down, and we asked you to track them. So let's look at SAP, Saputo, 10-day, 30-minute chart, 52-week high, June the 3rd, 42.42. It closed at 36.51. Its financials was March 31st, 3.7 billion, EBITDA 8.5%, net earnings 28.6%. So dividend rates is, so I would be looking, and if you can look at this chart here, right there, it took a dive sometime around June the 3rd. It took a dive all the way down to 36.55. It closed at 36.51. The RSI and the stochastics are both down. In fact, the stochastic shows oversold. RSI is below the midpoint, and the stochastics, MACD histogram bars are flat. So my target would be, now again, this depends on how much exposure you have to this company. So I would say 37, below 37 would be a decent buy with a $40 sell. Okay, $40, 39. You know, you make $1.50, $2. It's pretty good. You know, don't buy 10,000 shares. 500 shares is good. Make $1,000. That's fine. TIH, a 10-day, 30-minute chart. Again, 110. It's 108. Pretty close. My buy would be 107. At 107 or below 107 would be great. And a sell of 109. And you can see it has shifted from 110 to 109 as the support. Yeah, and 110 as the resistance, and it's moved down to 109 as the support resistance, and 107, 108 as the support. So you want to look at that. It pays a decent $1.40 dividend, $100 share though, but the $100 share that you can buy in a bank would probably, if you're looking at dividend income, would be better. But if you're looking for a few dollars in a shorter term time frame, and you can see it moves from 107 to 109. So if you get it to 107, that'd be great. WFG 110 versus 97. Quick drop there. You see it dropped around the June the 1st, June the 2nd from 194 right down to 86. Okay, so 90 was the break as the tracking point. Down $10 if you're at 90. More than that, down again. You're seeing a move of this WFG up and down, going all over the place. So two good important news is that it increased its quarterly dividend from $1 to $1.25, and they were buying a share purchase program of 9.5 million shares will be bought. So we have to watch this. It may suddenly take off, but keep an eye on this particular stock. The longer term view is that WFG timber company will do well. BMO, June the 4th, 129 is the 52-week high. It closed at 126.92. There is a $3 range from the 52-week high on June the 4th, but I would just track this with a potential buy 126 and 129 sell if you want to own the bank stock. All right, so you have to look at the RSI stochastics MACD, but generally track the stock. BMO it's a good stock to own. $4.25 in terms of dividend. CTC, Canadian Tire, 10-day, 30-minute chart, 52-week high was 213, is down $10. Closed at 203.89. $4.70 dividend. We will wait for a pullback. We will look. We are happier closer to below 202, preferably 200 is the target that we're looking at. BNS, June the 3rd, $82.80, closed at 80.96. Still too close to the 52-week high, $3.60. Technically, indicators are flat. This stock has a tendency to move quite slowly, so you want to take a look at it carefully as you look at the overall portfolio. Now, the stocks that we are looking at right now is Enghouse Systems and the two gold stocks. I mean, FNV has been down to 84, down $3. ENGH is down $2, and AEM down 94 cents. Something to look at. I'm not telling you to go out there and buy it. I'm just telling you to track the stocks so that if it drops more than what we anticipate, that you have the opportunity to acquire it. All right, that's all we have at this time. So a couple of things that you need to pay attention to is the G7 fallout, whatever statements that are going to be made in the next couple of days. You need to pay attention to that, economic reports that are due, and of course, the COVID challenges that you will need to pay attention to. Thank you, and we'll talk to you soon.